Welcome to lecture 18 of financial risk management. We are continuing our discussion on option strategies. Moving on to the contents, we previously discussed covered call strategy, and in this video we are going to explore protective put and fiduciary call strategy. These two are different strategies, and these two strategies are important in a sense that when we develop our first theory, which is called put call parity theory of calculating or estimating the intrinsic value of the option, then we are going to use these two strategies, and we will explore it in future lectures when we develop this the theory. So anyhow, the idea is that these two strategies are important in the sense that they would help us in developing the theory to find the intrinsic value of the option. Starting with the protective put strategy. So what is protective put strategy? It is a strategy or an option strategy and in which investor purchases a put option. By purchasing a put option, you mean you go to long put option to guard against any losses on the underlying asset which is already owned. So that means, as with the covered call, in covered call we had two positions. One, we owned the asset, we had the asset, and we took a short call position. In protective put, we again own the asset. That is similar as was in case of covered call. So we own the asset in protective put, and we also take a long put position. And by long put position, long put was when you want to sell an asset. So it is a right to sell an asset. So you purchase the right to sell an asset. So when you combine these two positions, you have a protective put strategy. Now, when do we go for protective put strategy? When we think that the market is bullish, but we want to protect our downside risk. So if you see when we have a put option, when we have a long put option, what it means is that if the prices decreases, even then we would be able to sell at the strike price that we have decided in our long put. So in that way, we have protected our downside risk. By downside risk, we mean that the risk that would occur due to the decrease in the prices. But as the prices increases, we can enjoy the profit of increase in prices. So we know the market is bullish, so we want to keep the upper ceiling open. We want our profit to increase as the prices increases, because we know that the prices would increase. But at the same time, we want to create a floor. And as soon as the market price hits that floor, our profit or our loss would be locked at that price, and it wouldn't, it would protect us. Okay, so how would the graph look like? This graph had been taken from the corporate finance book by Ross. So this is our normal graph when we buy a stock, when we hold a stock, and this was similar when in case of the covered call. As the price increases, our profit also increases. What about the long put option? In long put, our loss is fixed, but as the prices decreases, our profit increases, right? And when we combine these two strategies, this is how our graph would look like. Our loss would be limited, but our profit would increase as the price increases, right? So in a way, we have created this floor and when the stock price would decrease beyond this level, it wouldn't affect us. It wouldn't decrease our profit or increase our losses. But when the prices moves upward, it would increase our profit. So that means our profit is unlimited, but our maximum loss is limited. And it can be seen from this formula that for maximum profit we do not have any formula, because our maximum profit is unlimited. It is limited to the future spot price. The higher the future spot price is, the higher would be the profit. So it is unlimited in that sense. Our maximum loss is strike price minus the stock purchase price minus the premium. And we would again see the logic of this when we look into the example. The break-even point would be starting stock price plus the premium paid. So let's move towards the example for better understanding. The spot price is 170, strike price 150, premium is 35. So we need to calculate maximum profit, maximum loss, break-even, and we need to calculate profit and loss at these different future spot price. So again we are going to first solve this one, and then we would understand these other aspects too. So as was with the case of covered call, in protective put we again have two different positions. We have we own a stock, so our profit or loss from that position plus the premium that we pay for buying the long put. We combine them and we would have a total profit or loss of this protective put strategy. So what if the future spot price is 30? So if future spot price is 30, what would happen? The price have decreased, but remember to protect ourselves from this decrease in price, we have a long put. So we have the option to exercise or not exercise this put option. And what is this put option? That we would sell. The K was 150. So we have agreed, we have bought the right to sell this asset at 150. So no matter the price in the market, if we wanted to, we have a choice to sell it at 150. So now the market price is 30. What would you do? Would you sell it in the open market at $30, or would you sell it to the person with whom you have entered into the contract? Obviously you would sell it to the person with whom you have entered into the contract, because you have the right to sell it at that price. So because you would sell it at this price, so your selling price would be what? It would be 150. Now this long put is protecting you from this loss. Even the market price is lesser, but you are selling it at 150. So you sell it at 150. Your buying price was 170. Your loss from this position, from this ownership of this stock, our loss is 20. Our premium would always be minus 35, because we are going to pay the premium irrespective of the price. Our total loss is minus 55 from this whole protective put strategy. What if the market price is 90? Again, would you sell it at market price of 90, or would you sell it at 150? You would sell it at 150. You have the option. You can sell it at 150. So you sell it at 150. Your selling price becomes 150. Your buying price had always been 170. Your loss from this ownership of stock is minus 20. This would always be minus 35, because you would pay the premium at the start of the contract today, whatever the start of the contract time is. And this 150 or 30 or 90 price is from this time period. So this 35 had been paid and they are not recoverable. This is the price of buying the right from someone. What if the market price is 140? Obviously, you would not sell it on 140, you would exercise the option. Your loss from this position, your loss from this position, again, this was minus 55, right? Okay, so now it would change. When the future spot price is 160, what would you do? Would you exercise the contract or not? Would you sell it at 160 in the open market, or would you sell it at 150 to the party with whom you have entered into the contract? Obviously, you would sell it at 160 in the open market, so you would not exercise the option. So your selling price becomes 160, your buying price was 170, your loss from this position becomes minus 10. Your premiums would always be minus 35, so your loss from this whole strategy become minus 45. Now your loss is decreasing. What if the future spot price is 190, you again sell at 190 instead of 150. Your profit from this position, your loss from premium, total loss. What if the market price is 250, you sell it at 250, your profit from ownership of the stock, your loss from the premium, and your total profit is 45. So now you can see that your maximum loss is limited, but as you increase the spot price, let's say you can calculate it for the spot price of 2500, your profit would increase, right? So you can see that the maximum profit is unlimited. It increases as the spot price increases, future spot price increases, but your loss is limited to 55, minus 55, and that is the floor that this protective put strategy have created. So let's go back to that slide of maximum profit and loss and see how do we calculate it from there. One thing, our break even would be somewhere between 190 and 250, because at 190 we had a loss, and at 250 we had profit. So our break even, zero profit, zero loss, would be at somewhere between 190 and 250. It would be 205, but we would calculate it using the formula. So this was the maximum loss formula. Our strike price was 150, our stock purchase price was 170, our premium was 35. So if we solve this, we get the answer of minus 55. So this is the maximum loss that we can get from this specific strategy, protective put. It would depend on the case to case, but this is the formula to calculate the maximum loss. The break even would be 170 plus the premium paid, so that would become 205. So at this, if the future spot price become 205, then our profit and loss from this protective put strategy would be zero. We would not have any profit nor have any loss. So as we saw with covered call, we had a manual method of calculating the profit and loss of covered call strategy, and then we have a formula to calculate the profit and loss of covered call strategy. Similarly, we have a manual method of calculating the profit and loss of protective put strategy, and then we have a formula. So this is the formula to calculate the profit and loss for protective put strategy. This is what you are going to use. ST minus S naught. ST is future spot price, S naught is spot price. Maximum of 0, K is the delivery price, strike price or exercise price, the price that we have entered into the contract, minus the premium. So if you remember this part, maximum 0, K minus ST minus premium, this is the formula of long put option. So we have done nothing but we have used the formula of long put option and the selling price minus the buying price, because we have two parts in protective put. We own the stock, so the profit or loss of owning the stock would come from selling minus buying price. And then we have a long put, and the profit loss of long put would come from this formula that we have discussed in our introductory chapters of option contracts. So once we have developed our formula, let me see if our calculations were correct. When spot price is 30, we plug the value into the formula. The spot price is 30. The spot price, the buying price was 170. Maximum of 0, 150 minus 30. 150 is K. And 30 is future spot price minus premium. 150 minus 30 would give us 120. What is the maximum value? 0 or 120? It is 120. So minus 140, which is coming from 30 minus 170, plus 120 plus 35. This would give us minus 35, and this is what we calculated in our manual method. And I am going to also calculate it at 250. I am calculating it for the extreme values to give you idea, but you can use it for the other values. Okay, so 250 future spot price minus 170, maximum of 150 minus 250. So 150 minus 250 would give us minus 100. What is the maximum value? 0 or minus 100? It is 0. So 80 minus 0 minus 150 is plus 0, right? It doesn't matter anyhow. So the answer would be plus 45. So we saw in our manual method that when the future spot price was 250, our profit was 45. Okay, there is another example that I would suggest you solve it yourself for the sake of practice. John bought 100 shares. So again, ignore this 100 shares. This is just the units. So if you got, so in previous example, we got 45 profit when the future spot price was 250. So this is profit for 1 unit. If we had 100 units, so our profit would be 45 multiplied by 100. But anyhow, ignore this for the sake of simplicity. So John bought shares of Citigroup. It is listed in New York Stock Exchange for $30 in October 2012. I think it is more likely that the stock will go up. Now, you can get it from this sentence that John is of the idea that market is bullish, up even further in next few months, but to guard against the possibility of any drop, he bought a put option. So, bought a put option means long put on Citigroup stock. He paid $5 per option. This is the price of the option, that is the premium. And they carry an exercise price, this is K, of 50. Discuss his profit and loss if the future spot price is 100, 80, 50, 20 or 0. So you are going to calculate it yourself, but I have calculated it. I am just going to give you the numbers so that you know whether you are on the right track or not. For 100, it would be 65 plus 65. For 80, it would be minus 45. This is plus 45. At 50, it would be plus 15, plus 15, plus 15, right? So you can solve it yourself. Okay, so moving on to the next strategy, which is the last strategy that we are going to cover in this lecture, the fiduciary call strategy. In fiduciary call, we buy a call option and at the same time we enter into a risk-free bond, right? So we have two positions, buying a call option. So it is a long call, and then we have a risk-free bond. We buy a risk-free bond. So consider this. You enter into a long call position with the premium of $5 or rupees. So you pay 5 rupees as premium. The K price that you have agreed, the strike price that you have agreed is 100 rupees, and this long call would mature after say 3 months. These are the details. So when you enter into a risk-free bond, what you need to do is, you need to, first thing is have the same maturity. So if this long call is going to mature in 3 months, then this risk-free bond should also mature in 3 months for this strategy to work. Secondly, what should be the amount that you would invest in risk-free bond? The amount should be the present value of the strike price, the K, which would be 100. So instead of investing 100 rupees, we are going to invest the present value. Say for example, the present value is 90. This is a hypothetical value. So you are going to invest this 90 rupees for 3 months. So let's reread this sentence. The fiduciary call contains a call, a long call option, and a risk-free bond that matures on the option's expiration day, that is, they mature on same time period, and has a face value. So the face value, this is the face value, the face value that you get at the expiration should be equal to the exercise price of the call. So the face value should be 100. Face value doesn't mean you should invest 100 rupees today. Face value is the amount that you get at the time of maturity. Today you would invest the present value of that face value. So what would happen on expiration after 3 months? So imagine either this market price would increase of this commodity, this product would increase, or it would decrease. If the price increases of the underlying stock, if the price is below the strike price, so if on the time of maturity after 3 months, in market this asset is being sold at 80 rupees, so obviously you are not going to exercise this option and you are not going to buy it. Long call is the right to buy. You are not going to buy from the party with whom you agreed to buy at 100. You are going to buy from open market, but anyhow, this option would expire. It would not be exercised. So if the price is below the strike price at expiration, the call expires worthless and the bond is worth the strike price. What would happen is that you invested this 90 rupees at risk-free rate. This would become 100 after 3 months. So this is what the sentence is trying to say. The bond would be worth 100 rupees. What happens if the price increases? If the price increases, then say it is 120 rupees at the time of expiration, then what would you do? Instead of buying from the open market, you would buy from the person with whom you have agreed at 100 rupees. So what you can do is you can immediately buy it at 100 and sell it in the open market at 120. So you get the profit of 20, and then you would get this strike price of when this bond would mature. So the call, if the price of the underlying stock is above the strike price at expiration, the call expires and the worth of the call would be strike price, future spot price minus the strike price. So the worth of this call would be future spot price, which would be 120, minus the strike price, which would be 100. So the worth would be 20. Okay. So if you look at this this diagram, you buy this call and when you buy this call, your maximum loss is the premium, and as the price increases, your profit increases. At zero coupon bond, your price would be, your profit would be same irrespective of the future market price of the commodity. Because if the future price of the commodity, future spot price of the commodity either increases or decreases, you are going to get the same interest rate on your bond. So the combination of this these two positions would give us this kind of graph, where our loss would be limited, but as the future spot price increases, our profit would increase. Now from this graph, you would argue that this is the graph similar to the protective put graph. It looks similar. And you are right, they both look similar. And this is what this sentence is saying, that the investor gets the same profit whether they enter into a protective put strategy or they enter into a fiduciary call strategy. I repeat, the profit would be same whether an investor enter into a protective put strategy or a fiduciary call strategy. So buying a put and buying the underlying stock is the protective put strategy. Buying a call and buying a risk-free bond is a fiduciary call strategy. This statement says that they both would have the same profit. We are not going to prove this statement right now, but when we would develop our theory of option pricing, there we would prove that their profit is similar, and this is why this is helpful. We would talk about this in detail in our theory development of option pricing. But for now, just keep in mind that the profit of protective put and fiduciary call would be same.